Old money often lives behind thick walls in cities where stone grows out of the ground like a second geology. In certain districts of London, Paris, Montreal, or New York, the streets shrink to a hush at dusk. Townhouses sit in rows, their façades cleaned by time and money, their windows looking out onto a world that moves faster than the paintings inside. The rooms behind those windows are padded with objects that do not move much from year to year. Portraits hold their place on the walls. Silver remains in the family vault. The view from the balcony changes less than the national currency. The families who live in such spaces know, in a way that sounds cold to outsiders, that the numbers in the newspapers are the fragile part of wealth. What matters is what survives the erosion. Inflation, war, and financial collapse are three different acids poured over balance sheets. Inflation is a slow theft that works by changing the unit of account. The banknote stays the same size in your hand, but the bread and the rent do not. After the First World War, German citizens saw their wages and savings disintegrate in a few years as the mark lost almost all meaning. By late 1923, a single dollar bought trillions of marks, and a loaf of bread that had cost a modest sum suddenly required bundles of notes. War brings another kind of erosion, not through rising prices, but through physical destruction, confiscation, and forced conversion. Properties can be bombed, factories seized, currencies replaced, and legal claims simply erased by a new regime. Financial collapse, as in the Great Depression between 1929 and the late 1930s, strips away leverage and liquidity, turning once respectable borrowers into forced sellers when prices are at their lowest. For most people, these episodes arrive like weather. They experience them as news, then as shrinking grocery baskets, then as job loss or mortgage strain. They react by cutting consumption, selling what little they own, or seeking state support. For certain elite families, the same events are less like storms and more like stress tests in a laboratory. They cannot stop the rain, but they decide, decades in advance, where to place the stone. They choose assets whose cash flows rise with prices rather than shrinking under them. They avoid being trapped in a single legal system. They arrange their affairs so that, if one country devalues, another country's currency and courts still protect part of the family fortune. History offers a series of test cases. The inflation that followed the First World War in Europe punished bondholders and wage earners, but rewarded those who held land, rental buildings, and businesses that sold basic necessities. Deflation in the 1930s worked differently, pushing down prices and wages but increasing the real weight of debts, which crushed farmers and small firms whose revenues could not keep up with their fixed obligations. After the Second World War, governments in North America and Western Europe managed demobilization and pent-up demand with a mix of wage and price controls, then allowed a brief but sharp burst of inflation when those controls came off. In the United States, wartime finance had doubled the money supply while keeping private consumption suppressed. When peace returned, savings spilled into consumer demand, and prices jumped before policy and expectations cooled them again. The 1970s brought something more unsettling for economists and households alike. Oil shocks and policy errors combined to produce stagflation, a mix of weak growth and stubborn inflation. Central banks faced a grim choice: tolerate high inflation to protect employment, or crush inflation with high interest rates at the cost of deep recessions. In the early 1980s, the United States Federal Reserve chose the latter, raising rates to painful levels and breaking inflation expectations at the price of bankruptcies and unemployment. For heavily indebted households and firms, the cure felt as harsh as the disease. In the 21st century, war and inflation took new forms. Instead of general mobilization, there were targeted conflicts and sanctions. Instead of steady, predictable inflation, There were long stretches of low and even dangerously low price growth, followed by bursts of concern about deflation. Central banks responded after the global financial crisis with unconventional tools such as large-scale asset purchases, known as quantitative easing, where they bought government bonds and other securities to push down long-term interest rates and support weak economies. The aim was to prevent another Great Depression-style collapse by creating a floor under asset prices and credit. For households with no assets, the effect was often invisible except in rising rents and house prices. For those who already owned property and shares, the rebound became another mechanism by which existing wealth survived and even grew. The series you are watching does not center on the most photographed families of financial history. It looks past those whose names have become clichés of wealth and instead follows dynasties whose fortunes run through grocery shelves, data terminals, airport bookstores, discount sports chains, or unremarkable utility bills. In Canada, families such as the Westons and the Thompsons turned baking, supermarkets, and information into layered vehicles that ride price cycles rather than being crushed by them. George Weston began with a bakery in Toronto in the 1880s, building what became George Weston Limited, a holding company that now controls the country's largest supermarket chain and a major real estate investment trust. The Thompson family built an empire in media and financial data, controlled through the Woodbridge Company, a private holding firm that remains the principal shareholder of Thomson Reuters and owner of the Globe and Mail newspaper. In Europe, retail dynasties such as the Mulliez family in northern France and Belgium knit together an entire landscape of brands in food, hardware, clothing, and sporting goods under a tight shareholder pact known as the Association Familiale Mulliez, which controls chains like Auchan and Decathlon and coordinates the capital of hundreds of family members along the principle of all in everything. Industrial families such as the Dassalls and the Agnellis located themselves in sectors that states consider strategic, from aviation to automobiles, and later to health technology and luxury sports cars, ensuring that their companies were rarely left outside the room when governments drew up industrial policy or defense contracts. In the United States, more private dynasties, such as the Cargill and Macmillan families, placed themselves at the center of grain and commodity trading, with a company that connects farmers, processors, and global markets, and remains one of the largest privately held corporations in the country. These houses do not simply get lucky when prices rise or currencies fall. They assemble portfolios in which hard assets, control positions, and cross-border structures all have roles that only make full sense when you look across decades. Land and food companies act as shields against inflation. Holding companies and trusts sit between the family and any one jurisdiction's tax or confiscation risk. Multiple passports and listings give them options when regimes shift. Even their philanthropic foundations and media holdings help set the narratives through which their actions are judged. Over the next 3 chapters, we will look at how hard assets work in a soft monetary world, how borders become instruments rather than barriers, and how modern financial architecture allows family control to survive even when public markets convulse. Chapter 1. Hard Assets in a Soft World. Inflation punishes anyone whose claims on the economy are fixed in nominal terms. A salary contract, a bond coupon, a bank deposit, all promise a certain number of units of currency in the future. When those units buy less food, fuel, or shelter, the real value of those promises shrinks. For families that expect to span centuries, this is not an abstraction. The lesson is simple and brutal. Never rely on promises that someone else can water down. Own the things that people must pay for in whatever money the state issues next. Few dynasties embody this as clearly as the Weston family of Canada. George Weston started as a baker's apprentice in Toronto in the 1880s, then bought his own bread route and later a small bakery. By the early 20th century, he had built the largest baking company in the country. The family did not stop at selling bread. Under his successors, particularly W. Garfield Weston and his descendants, the holding company George Weston Limited acquired and built large stakes in grocery retail through Loblaw Companies Limited, as well as in pharmacy and other food and household retail chains, and later spun much of the underlying real estate into Choice Properties, a real estate investment trust. The mechanism is clear. In an inflationary period, the cost of flour, fuel, and labor may rise, but so does the sticker price on bread and groceries. Supermarkets that retain their market share can raise prices in line with or even ahead of costs, keeping their margins intact in nominal terms. The underlying land and buildings, often in prime urban locations, also reprice upward as replacement costs and land scarcity increase. A family that controls both the operating companies and the property vehicles owns a double shield: cash flow that tracks consumer prices and hard assets that track or exceed construction costs. The way the Westons structured these holdings matters as much as the sectors themselves. Rather than scattering shares across many individuals, control is concentrated through a parent holding company and associated trusts, allowing the family to steer strategy over decades and resist market pressure to prioritize short-term dividends over long-term positioning. When inflation rises, such structures can tolerate temporarily lower margins or higher investment in logistics if they secure stronger competitive moats, knowing that the family's real payoff arrives in the form of stores that continue trading, properties that continue collecting rent, and brands that remain familiar in every household. The currency in which those sales are recorded may change in value, but the act of feeding a city remains. Another Canadian example shows a different angle on hard assets. The Thomson family built its fortune first in newspaper publishing and then in a broader information empire. Roy Thomson began with local radio and newspapers in Canada in the mid-20th century, then expanded into television and later into a global data and media business. The family's primary holding company, Woodbridge, now controls Thomson Reuters, the multinational provider of financial data and news, and owns the national newspaper The Globe and Mail. Information is not a wheat field or a shopping centre, yet the way it is sold, via long-term subscriptions and data terminals embedded in the daily operations of banks, law firms, and corporations, makes it behave more like infrastructure than like a discretionary luxury. When inflation rises, the costs of running newsrooms and data centers increase, but so do subscription prices and software fees, especially when clients treat them as unavoidable inputs to their work. The Thomsons have also shown a persistent interest in land and property. Members of the family, including current chairman David Thomson and his relatives, have invested privately in real estate, from urban properties to rural estates, following the old pattern by which media visibility is paired with assets that cannot evaporate in a market crash. In effect, the family straddles two types of hard asset: land in the physical sense and data in the institutional sense. A court cannot easily force banks or governments to stop needing accurate information. As long as someone must provide it, someone can charge for it. If Canadian dynasties often appear understated, European retail families sometimes resemble private nations. In northern France and Belgium, the Mulliez clan has assembled one of the most dense and diversified retail networks in Europe. Through the Association Familiale Mulliez, a shareholder-packed and holding company founded in the mid-1950s, hundreds of family members co-own controlling stakes in chains, ranging from hypermarkets like Auchan to sports retailer Decathlon, home improvement group Leroy Merlin, and various clothing and electronics brands. Their internal motto, often translated as "all in everything," reflects a deliberate choice to reinvest dividends from one business into others, keeping capital circulating within the family ecosystem rather than letting it dissipate. The mechanism by which such an empire turns inflation into an ally is straightforward. Retailers in food, clothing, and household goods sit at the point where rising wholesale prices meet consumers' willingness to pay. In an inflationary surge, they face higher invoices from suppliers and sometimes higher wages. Yet they also have daily opportunities to adjust prices, change product mixes, and push more profitable private label brands. Their vast networks give them bargaining power with manufacturers and landlords. As long as volumes hold and customers remain loyal, higher nominal prices translate into higher nominal revenues. The family, owning the companies through a private association with long horizons, endures the noise of individual quarters in order to emerge from each cycle with a larger underlying share of the consumer's wallet. In the United States, food and energy provide other examples of how hard assets dull the bite of soft money. The Cargill and Macmillan families, who collectively own the majority of Cargill, have kept the company private since its founding in the late 19th century. Cargill today is a global commodities and food conglomerate that trades and processes grain and oilseeds, produces animal feed, and supplies ingredients and agricultural services around the world. During periods of inflation, especially when driven by commodity shocks, the nominal value of the crops, oils, and feeds that flow through Cargill's system rises sharply. Volatility brings risks, but it also brings trading opportunities and wider margins in some segments. Because the company's capital is not listed on public markets, the family can withstand years when margins compress in one division if another division benefits from the same macro forces. Ownership architecture is the hidden skeleton in all these examples. The Westerns use a layered structure in which a publicly listed holding company controls operating firms, and a separate real estate investment trust holds many of the underlying properties. The Molières family uses a private association with strict entry rules and internal discipline. Family members invest most of their wealth back into the association's companies and accept governance rules that few public shareholders would tolerate. The Thomsons and the Desmarais family in Canada use holding companies such as Woodbridge and Power Corporation of Canada to maintain long-term control over financial, insurance, and media groups, allowing them to think like pension funds rather than like quarterly traders. Each structure separates operating risk from family risk and, in many cases, from any single country's tax code or inheritance law. Inflation becomes, in this context, a mechanism that shifts purchasing power from those holding cash or nominal debt claims to those who own assets with pricing power. When consumer prices double over a decade, the wage earner's savings account erodes unless the interest rate keeps up. The family that owns the supermarket, the data terminal subscription, the apartment building above the store, or the grain terminal on the river sees its revenues and the nominal value of its assets rise with or ahead of the general price level. The trick is not mystical. It is simply to make sure that the family's balance sheet is packed with claims that float, not ones that sink. Chapter 2. War, Borders, and the Second Passport Strategy. War is the most brutal audit of ownership. Bombs do not check corporate registries. Occupying authorities redeem debts in new currencies on their own terms, if at all. New governments can nationalize factories or rewrite contracts. For families that have concentrated their fortunes in a single country and sector, this can be fatal. For those that have treated geography and jurisdiction as parts of a portfolio, war is terrifying but not necessarily terminal. Consider the story of the Dassault family. Marcel Dassault was born Marcel Bloch in Paris in the 1890s, trained as an engineer, and became involved in aircraft design during the First World War. Between the wars, he built a company that supplied aircraft to the French state, positioning himself in a sector that governments could not ignore. During the Second World War, as a Jew in occupied France, he was stripped of his citizenship, his factories were seized, and he was deported to the Buchenwald concentration camp. After liberation, the new authorities nationalized much of the French aviation industry, folding his operations into state-controlled entities. It looked, on paper, as though his wealth and influence had been erased. Yet the post-war decades tell a different story. As France rebuilt and entered the Cold War, the state still needed advanced military and civilian aircraft. Marcel, now under the name Dassault, re-entered the industry and developed iconic jets such as the Aragon, the Mystère, and the Mirage series, which became symbols of French technological prowess. Over time, the Dassault Group re-emerged as a major player in aviation, with the family holding significant stakes not only in the aircraft company, but also in Dassault Systèmes, a software firm, and in media assets such as Le Figaro. The mechanism here is not about hiding assets offshore during war. It is about aligning the family's human capital and industrial capacity with sectors that the post-war state is compelled to support, and then using political access to reclaim and grow positions in those sectors once the chaos settles. In Italy, the Agnelli family offers a different pattern of survival across regimes. Giovanni Agnelli helped found Fiat at the end of the 19th century and built it into Italy's dominant car maker. During the First World War, the company grew rich on military orders. In the interwar years, Giovanni became a senator and maintained relations with the fascist regime, which treated industrial champions as national assets. After the Second World War, Fiat faced scrutiny for its wartime role, but it was too central to the Italian economy to be dismantled. The company instead became one of the engines of the country's post-war boom, employing waves of internal migrants from southern regions and exporting cars across Europe. The Agnelli strategy was not only industrial, it was also jurisdictional. Over the 20th century, the family increasingly separated operating assets from the vehicles that held their shares. They created holding companies to consolidate their stakes, eventually merging these into Exor, which today is incorporated in the Netherlands, listed in Amsterdam, and controlled through a privately held company owned by the extended Agnelli clan. Exor now holds significant stakes not only in auto-related firms but also in Ferrari, CNH, industrial media, health technology, fashion, and professional football. When Italy changed its corporate governance rules or tax regimes, the family could respond at the holding level rather than being trapped by the constraints applied to a single operating firm. The concept, sometimes called a second passport strategy, is not only about literal citizenship, though many wealthy families do secure multiple nationalities as a hedge against political risk. It is also about giving their capital multiple passports. A factory can be tightly bound to a place, but the company that owns it can be domiciled in a different country. Shares can be listed in London or Amsterdam, even if the headquarters remains in Turin or Paris. Banking relationships can span Zurich, Montreal, and New York. For Canadian dynasties such as the Desmarais family behind Power Corporation of Canada, this cross-border architecture became a defining feature of their wealth. Paul Desmarais took control of Power Corporation in the late 1960s and transformed it from an electric utility holding company into a diversified financial and industrial group with core holdings in insurance, retirement services, wealth management, and various European industrial companies through alliances with partners such as Belgian investor Albert Frère. Power Corporation and its subsidiary Power Financial acquired stakes in Great-West Life Investors Group and later additional asset managers, and developed investment platforms in Europe and Asia. The family's investments flowed through both Canadian and European legal systems, and through public companies and private vehicles. Political connections across Canada and France added another layer of informal protection. If one jurisdiction tightened regulation or taxation, the group's overall structure could absorb the shock. Canadian banking and insurance regulation itself provided a kind of indirect shield. The country's financial system has long been concentrated and tightly supervised, with capital adequacy requirements that often exceeded international minimums, which helped its major institutions avoid the worst damage in global banking crises. A family that anchored its wealth in such institutions, and did so through diversified holding companies and long-term share blocks, was effectively buying into a more conservative and resilient legal environment while still gaining exposure to global markets. War and geopolitical upheaval also created new profit streams for those already positioned in strategic sectors. For the Dassaults, the Cold War arms race and France's desire for strategic autonomy in defense spending ensured steady demand for advanced fighter jets and business aircraft. For the Annelis, post-war reconstruction and the expansion of European consumer markets supported mass car ownership and infrastructure projects. For commodity families like Cargill, periods of conflict and sanctions reshaped trade flows and created arbitrage opportunities in grain and energy, rewarding those who could move cargoes across borders when others could not. Legal tools turn these geographic bets into durable structures. Re-domiciling a holding company from one jurisdiction to another, as Exor did in choosing the Netherlands, can expose the group to more favorable tax treaties, voting right arrangements, and corporate governance rules. Using trusts allows families to place assets under the stewardship of trustees in stable legal systems, shielding them from potential confiscation or punitive inheritance laws in their home countries. Listing shares on foreign exchanges spreads ownership and raises capital in currencies that may be more stable or cheaper to borrow. In some cases, families have used shipping registries in neutral countries or holding firms in places like Luxembourg, Switzerland, or the Channel Islands to hold stakes in shipping, mining, and insurance companies that operate worldwide. The human side of the second passport strategy matters as well. Members of these dynasties often study abroad and maintain homes in multiple countries. The Desmarais family, for instance, developed close political and business ties not only in Canada but also in Europe and China, founding the Canada-China Business Council and holding board seats in European holding companies. For the Agnellis, relations with both Italian institutions and international partners in America and elsewhere allowed their companies to form alliances and mergers that softened the impact of domestic downturns. When one country became politically inhospitable, the family could lean on networks and assets in another. Seen from the outside, all of this can resemble a kind of unfair escape hatch. Ordinary citizens must live with the fortunes of their passports and their local banks. Dynasties move their capital across borders as if shifting pieces on a board, yet the logic behind it is consistent. If war is a risk that can wipe out an entire country's assets, then owning claims in several countries is as rational as diversifying across industries. The families profiled in this chapter did not always avoid loss. They saw factories bombed, companies nationalized, and reputations damaged by association with the wrong regime. But their assets and relationships were arranged in layers, so that the loss of one layer did not mean the loss of all. Chapter 3: Surviving Inflation Regimes and Financial Collapse. By the late 20th century, the main stress tests of wealth in advanced economies shifted from total war to regimes of inflation, deregulation, and financial crisis. Currencies still changed value, but central banks now floated them against one another in global markets. Governments still intervened heavily in the economy, but often through interest rates, bank regulation, and social insurance, rather than through direct ownership of factories. Families that had survived earlier eras of shock did not retire into passivity. They learned to speak the new language of risk: private equity, derivatives, conglomerate discounts, tax-efficient foundations, and reputation management. The German Reimann family offers a case study in how an old industrial fortune mutated into a modern holding company that straddles consumer brands and financial engineering. The family's wealth originally came from a chemical company, Benckiser, founded in the 19th century. In the late 20th and early 21st centuries, under the guidance of managers such as Peter Half, the family built JAB Holding Company into a vehicle for acquiring stakes in coffee, beverages, fast casual restaurants, beauty products, and later life insurance and asset management. JAB took large positions in companies like Jacobs, Dowey, Egberts, Keurig Dr. Pepper, Krispy Kreme, Pret a Manger, and Coty, often using leverage to finance deals and betting that steady consumer demand in coffee and indulgent snacks would provide resilient cash flows. The mechanism here differs from the traditional grocery or utility model, but rests on a similar logic about inflation and collapse. By owning brands that sell affordable treats and everyday beverages, the holding company positions itself in categories that consumers continue to buy even during downturns. At the same time, by using debt and financial structuring, JAB amplifies the family's exposure to those cash flows. This can backfire, as seen when some of its consumer bets underperformed, and its portfolio value fell during the pandemic and subsequent inflationary period. Yet the family's response has been to pivot, channeling capital into sectors such as insurance that offer long-duration liabilities and relatively stable returns, echoing the way some earlier dynasties moved from industrial plant into financial claims on households and firms. In parallel, the Agnelli family's Exor refined a model in which a listed holding company, controlled through high voting shares owned by a family vehicle, manages a portfolio of industrial and consumer assets across countries and sectors. Exor's stake in Ferrari, for example, combines exposure to a luxury sports car manufacturer with tight control mechanisms and a brand whose pricing power is unusually strong. The company can raise prices and manage waiting lists even when broader auto markets slow. At the same time, Exor has invested heavily in health technology companies such as Philips during periods when those firms faced regulatory or reputational difficulties, betting that long-term demand for medical imaging and related technologies will outlast short-term market panic. The tools Exor uses are characteristic of late 20th century dynasties. Dual-class share structures and shareholder agreements separate economic ownership from control, allowing the family's vehicle to hold a smaller share of the capital while retaining a majority of voting rights. Buyback programs and special dividends allow the holding company to adjust its capital structure in response to market valuations, sometimes shrinking the free float to close the gap between share price and net asset value. Tax planning takes place at the level of the holding's domicile, where treaties and rulings can reduce withholding on dividends or capital gains when assets are sold. Across all of this runs a guiding principle recognizable from older eras. Do not be forced to sell core assets into a crisis. Instead, keep dry powder and flexible capital so that when markets panic, the family can accumulate more of the assets it prefers. Canadian and Scandinavian models have influenced this thinking. Research by institutions such as the Canada Pension Plan Investment Board has highlighted how family-controlled businesses can be strong partners for long-term investors due to their willingness to reinvest earnings and endure short-term volatility in pursuit of multi-decade strategies. Many European industrial families have used foundations and long-term shareholding vehicles, often anchored in cities like Stockholm, Copenhagen, or Brussels, to hold controlling stakes in companies while insulating them from hostile takeovers or activist campaigns. These foundation structures treat shares almost like heirloom land, meant to provide dividends and influence to future generations rather than maximum current price. Foundations and philanthropy also serve another function: reputation management. Several dynasties profiled in this series have faced public scrutiny for their histories, whether for wartime conduct, labor practices, or the source of their original wealth. The Ryman family, for instance, has publicly acknowledged and investigated its ancestors' involvement with the Nazi regime and funded research and charitable initiatives through the Alfred Landecker Foundation. Foundations become vehicles through which families can signal contrition, reshape their public image, and support causes that align with a more acceptable modern identity. They also, in many jurisdictions, provide tax advantages when transferring assets and help organize governance by bringing family members together around shared projects. The late 20th century's inflation regimes created their own demands on these structures. In the 1970s, high inflation and energy shocks battered bond portfolios, but families with large positions in commodities, utilities, or real assets often saw their nominal revenues rise. In the 1980s, aggressive interest rate hikes strengthened currencies and rewarded holders of cash and government bonds, but they also sparked recessions that generated opportunities to buy distressed assets. The global financial crisis at the end of the first decade of the 21st century punished, leveraged financial institutions and households dependent on rising house prices, yet it also opened the door for those with capital to acquire banks, insurers, or industrial assets at discounted valuations. Central bank quantitative easing programs then lifted the prices of financial assets and real estate over the following decade, enriching those already invested and stretching the gap between asset owners and wage earners. In each of these cycles, the pattern for dynasties was similar. Before the storm, they had built thick buffers of equity in their core holdings and avoided excessive margin debts that could trigger forced sales. When rates rose, they could absorb lower dividends or adjust leverage at the holding level. When prices collapsed, they had the option to increase positions in businesses they understood, often in partnership with other long-term investors, like sovereign funds or pension plans. Their internal family governance systems, honed over decades, gave them a way to make decisions without the public drama that often surrounds listed companies. Reputation and narrative are the last layer in this architecture. In earlier centuries, aristocratic families relied on titles, estates, and marriages to signal their place in the hierarchy. In the age of financial media and social networks, dynasties rely on a mix of quiet control and carefully chosen visibility. Owning a serious newspaper, as the Thompson family does with the Globe and Mail, or a respected daily like Le Figaro in the case of the Dassaults, embeds the family in the national conversation and lets them frame economic and political debates, even as professional journalists insist on editorial independence. Philanthropic initiatives in education, culture, or health attach the family name to socially valued projects rather than merely to consumption. The message, whether explicit or not, is that the dynasty is not just rich, but also useful. Taken together, the three threads that opened this documentary form a single, harsh examination that every large fortune must eventually sit. Inflation asks whose claims on the real economy can float when the measuring stick changes. War asks which assets are tied too tightly to a single regime or border. Financial collapse asks whose balance sheet is strong enough to avoid forced selling at the bottom. The families we have examined do not escape these questions by accident. They rehearsed answers in advance, assembling portfolios of hard assets, cross-border entities, strategic sectors, and governance structures that allow them to bend rather than break. For most viewers, the point is not to imitate the exact structures of billion-dollar dynasties, nor to excuse their histories. It is to understand the mechanics by which some forms of wealth survive when others wash away. The quiet lesson of old money is not that money is eternal. It is that certain kinds of ownership, patiently built and defended, are designed to outlast any single currency, government, or boom, and that the true luxury of such families is not the house or the car, but the feeling, passed from parent to child, that they have rehearsed the next crisis long before it appears in the news.